Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 346 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including intra-year drawdowns versus year-end returns, 2026 revised earnings estimates for the S&P 500, and the strong recent rally in stocks over the past 10 days. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Good morning, Mark.
Before we get started, I just have to throw it out there that my Buffalo Sabres finally are in the playoffs after a 14-year drought.
I'm extremely happy for you.
Yeah. So
they're not just in the playoffs. Be more specific.
Yeah, won their division, home ice advantage, which is fun. So first time in 14 years as a fan. I grew up playing hockey close to Buffalo. Saturday or Sunday their first game, and then going to the second home playoff game with my dad, which will be fun because the last time we did that was in 2007. So I was
Life's very different.
I was a young lad at that point. So still looking forward to that next week. So
a fun fact, why don't you tell listeners and viewers what position you played in high school?
I was a goalie. Yeah,
he was a goalie.
Typically, people look at goalies like we're a little bit crazy, got a couple screws loose in the old noggin, which I guess you can tell people if that's accurate or not. But
it's not accurate.
But yeah, so I was a goalie growing up. I played essentially my whole life. Me and my brother played on the same travel teams and high school teams, so it was a big part of our younger life and growing up, and my whole family's been huge hockey fans and Sabres fans, and it's been a sad 14 years. We don't pick sports teams very well in my family for some reason, so I'm hoping they change it up this year.
It's your time in the sunshine, baby.
But getting back to it, what a crazy turn of events we've had just over the past week and a half here. I know we'll get into it here in a little bit, and I'll get your thoughts. But first, as always, want to review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on April 15th. S&P 500 index up 7.6% so far halfway through the month of April, and up 2.6% for the year. Dow Jones Industrial Average up 4.6% for the month and up 0.8% for the year. The NASDAQ Composite Index up 11.2% for the month and up 3.3% for the year. The Russell 2000 Small Cap Index up 8.6% for the month, up 9.4% for the year. And the Vanguard All World X United States Fund up 7.2% for the month and up 9.4% for the year. 3-month Treasury rate at 3.7%, 2-year rate at 3.76%, and the 10-year at 4.29%. So like I said, Matt, as of April 14th, which was 2 days ago, S&P 500 was up almost 10% in 10 days, showing that so far it's been quite a strong V-shaped recovery that we've seen become more and more common over the past, I would say, decade, maybe 7-8 years.
Yes, sir.
So I'll leave it there and just let you give your thoughts.
We talked a lot on the podcast over the past 5-6 weeks about the market that we were going through. We were highlighting things such as short levels in the market, meaning how many people were betting on additional downside. We were talking about how many people out there had put options, which is a form of downside protection in the market, were at extreme levels. We were talking about cash levels on the sidelines were extremely high. And then we kept talking about how earnings estimates on Wall Street, despite the geopolitical headlines, were continuing to go up for the rest of the year. Now, did we know exactly when the market was going to turn? Absolutely not. But we did highlight on the podcast several times that Q1 earnings season is going to be at the end of April, and most likely those earnings were going to be favorable. And once you had a clear break in the geopolitical headlines where people could start understanding when oil was going to move again, I think the market was going to move and move quickly. And I want people to listen to this very closely. This is a good learning lesson as to why you do not try to time this market. This is a market that can move very quickly in both directions. You saw the downside hit, you saw the sentiment in the market be real poor, and then all of a sudden, in 10 trading days, sentiment has completely flip-flopped. You've had now an environment where a lot of people sold, capitulated due to the headlines, and they strayed away from their long-term plan. Will it happen again? Absolutely. Will we have most likely a correction later this year, statistically, in these midterm election years, Mark? Probably. I think this is a good reminder about being cautious on trying to time this market.
Yeah, it's a great little monologue that you had there. And, it always feels worse when you're in the middle of it. But then when you have something like this happen, it's like, of course, the market was up 10 days in a row, right? Like that's just how these things ends. When the news tends to be or seems to be at its very worst at peak pessimism is typically when things turn around. And it was a great point you made that we absolutely did not know exactly when that was going to happen, but we had, I would say, a sneaky suspicion that we were getting closer and closer to that than we were back in January or February.
It's well said, Mark. I think when it comes to market psychology of two aspects, the fear and greed aspects, but also the speed in which information flows, I think that as we get more technologically advanced, I'm in this camp that the corrections are going to happen quicker. The drawdowns might be more. However, the recoveries will be quicker, and the recoveries will be more than they have previously. Mm-hmm. And that's an important point, because I think a lot of investors get trapped into this thought process. Well, if I just lower my risk footprint dramatically, I'm not talking just a little bit, being tactical, but if I sell a ton of stock exposure, I'll buy back in when I feel more comfortable. Well, let's take yesterday as an example. The market has moved very quickly, and it was up again nicely yesterday. And you could just kind of feel the market sentiment, Mark. I could feel it in the market, all the bears saying, there's no way this market could go even higher. Guess what? It's probably going to go higher over the next week because the sentiment is that way.
Right.
Does that make sense?
Yeah. Yeah. And just to be clear too, all it takes is one news headline, one break of the ceasefire in the Middle East, one tweet, and we could be back where we were a couple of weeks ago.
Absolutely.
But at least for right now, it's been a pretty strong run to the upside. So
this is a great intro.
Yeah, no, I think it was pertinent to take some time and address what happened over the past week and a half or so. So
before we get into this week's show, listeners, if you've been enjoying the Independent Advisors podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to our normal schedule of events. First thing I had was a post on LinkedIn from Peter Maluk on April 4th. And this was, again, on LinkedIn. He said, over the last 75 years, the average intra-year market drop has been 14%, meaning from the high of that year to the low, the drop is 14%.
Listeners, are we listening to this? It is normal for double-digit intra-year corrections.
And
that's normal.
For the S&P 500, we didn't even reach 14% this year, right? So If you're overly stressed about the current 9% drawdown, the stock market isn't for you. Downside volatility is the price investors pay for long-term outperformance. And Jenna will put this chart up on the YouTube page. It'll be in our show notes, but he also shows the chart of this going back to the early 1980s. And what you're going to see is the blue histograms show the return and at the end of the year for the S&P 500, and then the red dots show the intra-year drawdown. So, for example, 1987, at one point, stocks were down 34%. They finished the year up 6%. Another one in 2009, stocks fell 28% at one point in time. They ended the year up 26%. So you can kind of see where I'm going with this. The theme is that, if we do have large pullbacks, number one, that's very normal. And number two, that doesn't mean that stocks can't rally to finish the year positive. So I've seen, I think,
great piece.
and have shared multiple iterations of this,
Sure.
but thought it was timely to do so. Second thing I had was on a similar line, post from Ben Carlson on X on March 30th. He says, no one knows how long a correction will last when you're in it, but buying stocks when they are down tends to be a good long-term strategy. A look at what happens when you buy the stock market down 10%, 20%, and 30%. So again, Jenna will throw this chart up on the YouTube page. It'll also be in our show notes. But what this does is, again, shows the returns for the S&P 500 after some pretty big drawdowns. So after being down 10%, 20%, or 30%, and as you can imagine, Matt, the more or the worse the drawdown gets, the better the future returns are. So it shows returns going out 1 year, 3 years, and 5 years. And as you can see, the numbers are pretty strong. So again, I think this is another reason why it pays to have that long-term mindset, and just knowing that going into each and every year, you should expect a 10 to 20% pullback at some point in time.
Yeah, well said. I love that. Another great piece that you selected. I just want to remind our listeners and our viewers that our show notes are located on all of our social media sites. So if you pull up Jessup Wealth Management on the likes of Facebook, LinkedIn, X, etc., you will find all those show notes after each podcast is released. Typically on Thursdays is when Jenna conducts that.
Yeah, thanks for pointing that out. And finally, so you don't have to hear my allergy-ridden voice anymore, the last thing I had was a post on X from Charlie Bilello on March 29th, and he said the S&P 500 is down 7% in the first 59 trading days of 2026, the 14th worst start to the year in history. And what I thought was really interesting about this, Matt, is that if you look back, going all the way back to 1928, the worst start to a year, if we're talking about the first 59 trading days, was 2020. S&P 500 was down 18.6% in the first 59 trading days. But guess what the rest of the year did? From that point forward, it was up 42.8% and finished the year positive 16.3% of the time. And I know people probably are sick of me saying it, because I think I've said it a lot over the past couple of months, but just because the year starts off weak does not mean the rest of the year has to follow suit. And I think that this is a perfect example of this. And could it? Yes. The fifth worst start to the year, S&P 500 was down 10.5% the first 59 trading days. The rest of the year, day 60 through year end, it was down 2.9%. So the market finished down 13% for the year. So it doesn't always have to rally and finish positive, but I think the data shows that happens more often than not.
Well said. I have zero things to add to that.
Great.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
My first piece, Mark, I'll give your voice a rest. And by the way, it doesn't sound bad at all. But everyone I know right now is getting hit with allergies in the Miami Valley. For out-of-town listeners, they tend to hit pretty hard all at once here in the Dayton area.
They do, and I've never been someone who's been too affected by allergies, but for whatever reason this year it's been brutal.
Have you been outside more?
Yeah. Mia loves playing outside, which is great.
There it is.
But yeah.
Okay, so my first piece has to do with S&P earnings forecast for 2026. I had a piece about this a couple of weeks ago, and it was near the end of March, and sentiment was really poor. And I brought out this piece that separated the 4 quarters of this year, and it showed average Wall Street estimates for the S&P 500 index by quarter, and the estimates throughout the month of March. Despite the geopolitical headlines and the uncertainty that we saw, those earning estimates were going up. And I highlighted that on the podcast. I'm like, listen, there's a difference here between fundamentals that are being forecasted underneath the surface and the things that you're seeing. Mike Zaccardi posted this on April 3rd. And it shows Bank of America's market strategist showing that S&P 2026 earnings per share have been revised higher by 4% since the beginning of the year on January 1st. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And what it's illustrating, Mark, is an overlay of earnings per share for the S&P 500. Obviously, this is forecasting right now, and it shows an overlay of the S&P 500 sell-off. And obviously, you see a very a dramatic difference between earnings going up and the index selling off. And what I was telling clients face to face at this time is both can't be right. Someone's lying on this chart. Someone's got it wrong. And I think the earnings are more sticky. I'm not saying that they're going to continue to go up. They could come back down, even if they come in 4 to 5%. Still attractive compared to where prices have been, even though it's rallied.
Yeah.
I just want to kind of throw that out there.
Yeah, and for our newer listeners, we've talked about it, at length every single year about what drives stock prices, but maybe for those who are listening for the first time, earnings of these publicly traded companies is what drives long-term performance of share prices, right?
Exactly, sir.
And, I'm not talking about, day-to-day, week-to-week, month-to-month. There's a lot of things that can happen, but long-term earnings are what drive stock prices. And when you see this disconnect where earnings growth is literally going vertical virtually, and you're getting this correction in the S&P 500, usually going back and looking throughout history, it hasn't been a horrible place to buy or put some money to work because they got to catch up to each other. Earnings is going to catch down to stock prices, or stock prices are going to catch up to earnings. And, with the market being up 3 out of every 4 years, I would think it's going to be the latter.
Well said. I'm loving the podcast today.
Yeah, it's a good one.
All right, next, I have an interesting stat on the NASDAQ 100, Mark. This is from Blue Kurtic Market Insights. And what they posted on April 14th is that the NASDAQ 100 is set to do something it hasn't done since 2021 and has achieved in only 14 other years since 1986. It closed positive for 10 consecutive days. In 13 of those 14 years, NASDAQ closed the year positive with an average gain of 25.6%. Anything you want to say?
Yeah, it's pretty amazing that we go from, the doom and gloom that we were just in less than 2 weeks ago to statistics like this.
Do you feel like we're in a parallel universe?
Yeah, information just changes so quickly. I mean, even research that I read, I was, 2 weeks ago, I was really taking a hard look at things and looking at our portfolios that we manage for clients. And I was like, questioning if this was going to get worse before it got better. Right. And there were a lot of, scary statistics out there. And at the end of the day, you just got to fall back on your game plan and your risk management. And, if you wouldn't do something out of the ordinary during situations like this, then you probably shouldn't now. And, that's the decision that I made. But yeah, I'm not going to lie. Just like everyone else had concerns 2 weeks ago, we did too, right?
I mean, you be sitting there on a Sunday afternoon, and obviously you see the doom and gloom of these headlines of influential traders who are like, oh, Monday's going to be horrible for the market. It's going to be down at least 3.5%. And it was green.
Yeah. And that's one of the things that I hate news-driven markets, because it makes Sunday night not fun, because I'm reading research throughout
Sunday
the
night
weekend and
sucks
stuff, and it's like
let's just say
and then, I'm getting Wall Street Journal notifications, futures down X%, and I'm like, God, now I'm going to think about this all night.
Absolutely.
And so I'm hoping we're nearing the end of that for a little while.
I'm here for this. My last stat is from Charlie Bolello, friend of the podcast. Big drop in the VIX, the volatility index. The VIX, we've talked about it several times in the podcast, Mark. For our newer listeners, it is a proprietary index that watches options trading, and it develops kind of a fear gauge for the market. Is that a quick way of kind of explaining it?
Yeah. Typically when volatility's up, stocks are down and vice versa. So it's a good way to gauge, what stocks potentially could do over the next 30 days.
So what this piece is talking about from Charlie is that, and this is time-stamped April 14th, Mark, the 38% decline in the VIX over the last 2 weeks is the 7th biggest volatility crash is appropriate, in history. Jenna will put up this illustration for our YouTube viewers. This will definitely be in our show notes. Why am I highlighting this? Look at this data set. And when you see dramatic drops in the volatility index, and you look at the forward returns on average, 6 months later, average return 10.6%, and then 1 year later, 17.2%. The crazy stat is 1 year later, of this data set, you only have 2 that were negative, the minority 1 year later, and they have returns that go out 2, 3, 4, 5 years, which I'll avoid. But the point I'm making here is when you tend to see these bigger drops in the VIX index, it's another bullish indicator. Your comments?
Yeah, I just, if you look at this data, each of these biggest or largest 2-week declines in the VIX, if you were to put money to work at each of these instances, and there's roughly, 25, Matt,
Yeah,
it looks like.
Yeah.
Each time, if you put money to work on that date, 2 years forward, you never lost money.
Correct, sir.
And I'm not saying that can't change this time around.
Correct,
but the
sir.
data is pretty strong, right? So there is a high likelihood, in my opinion, this isn't advice, that if you put money to work today on April 16th of 2026, when we reach April 16th of 2028, the
high probability is
the S&P 500 will be higher than where it is today.
I think
just going based on data that we have, right?
Yep.
And if you are a long-term investor that does not need to access capital within a 2-year period, you shouldn't even be concerned with any of this stuff.
Well said. I got another point I want to make on this chart. We've been talking on this podcast about the evolution of how quick information flows, technological advancements in the market. Look at a lot of these data sets. The VIX has a multi-decade history. What are you noticing on these biggest volatility drops with these years posted next to them, Mark? They've been recent. This is proving the point that we're discussing. 2016, the biggest, 2018, 2016, 2013, 2021, 2020, this year, 2024, 2020.
2025, 2022.
I mean, this is just another piece of supporting data of what we're discussing. So I think we should end the podcast on this note. We have to anticipate that looking forward, market volatility is not going anywhere. It's probably going to increase.
All right.
And I think from that lens itself is definitely a point that investors are going to have to come to grips with.
Yeah, I agree. I just think, if you take a look at, what AI has already done in terms of automation or making things quicker, making people more efficient, it's going to do the same thing with markets, especially some of these larger institutional money managers. I think it's just going to accentuate the move to, like what you were talking about, where markets are just going to start to move quicker and quicker and quicker because a lot of it's going to be more and more automated. And I don't want that to scare people because there's been so much innovation since the inception of the stock market until where we are today. And each of those periods of innovation probably felt something similar to this. Like we're hitting this point of no return where things are going to get really bad. But if you just look throughout history, that's not what happens. Is technology continues to innovate.
You said it perfectly.
So I don't want people to be scared by that. It's just the reality of what we're dealing with.
No, and I think let's end on this point. Let's go back to the last 3 or 4 weeks. When you're in that environment, psychologically, there are investors out there who are thinking, well, I'm just going to sell stock exposure and, I'll get back in when it feels better. And then you go on a 10-day run of 10% higher in the market. That is proof why you can't do that.
Yeah.
And you got to stay invested for the long term in quality companies and let time be on your side.
Yeah. And like you said, I'm not, we're not talking about small tactical moves or selling this to put money in to buy this. We're talking about going from 80% stock to 40% stock.
Correct.
Or 90% stock to 30% stock.
Correct.
Like that's what's really going to kill you. I understand
the TED Talk. We should start charging for the TED Talks.
I understand reducing, risk, right? So like 2 weeks ago, if you were like, I don't really know, maybe I should, sell a name or two, take some chips off the table
That's
that
tactical.
I've made some good gains in. That's tactical. Huge equity shifts where you're going way, way down the risk scale is
that are against your long-term goals and objectives. That's emotional.
Yeah. Yeah. So, well, good. I think we covered a lot in a half hour. So thanks everyone for listening to episode 346 of the Independent Advisors Podcast. Catch us next week for episode 347.
We'll see everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.